Imagine there's free money on the streets. Will you take it? Of course you will. It's stupid not to take it. Buying cheap stocks on the stock market is just like taking free money on the streets. And today, I will teach you how to buy cheap stocks on the stock market so you can take that free money. Coming right up. Today, I want to talk to you about the importance of buying stock cheaply. You see, the golden rule about investing is to buy low and sell high. The next question that comes to your mind is, how low is low? How high is high? The low can go lower and the high can go higher. Let me straight on answer the question. Please pay attention. Stocks are low when prices are low relative to the returns that you can potentially make, assuming that chances are equal. If you only need to risk $1, but you can potentially make $2, that's a great deal, isn't it? This is an example of a low risk and high return opportunity. On the stock market, you get these low risk, high return opportunities when stocks are on sale. In order to determine whether a company is on sale or not, we must look at what is called the margin of safety, which is reasonable discount in relation to the true value of the company. This is critical in reducing risk because it is the number one way that we can maintain a portfolio over long periods of time without experiencing significant loss of capital. When we have good margin of safety, we take care of our downside. We reduce the chances of capital loss. When you take care of your capital losses, you don't have to worry about many things. You don't have to stress over losing too much money. You will sleep better at night. You are psychologically stronger. So I believe that taking care of our downside and protecting our capital is the most important. You may be asking next, hey, what about upside? I come to the stock market to earn money, not to park my money into companies without any upside. I'm not here to do any charity. And yes, I totally agree with you. Stock market investment is definitely not charity. But here's the thing, the stock market is volatile. Prices go up and down on a daily basis. Take care of your downside and your upside will naturally come in the form of price fluctuation and temporary mispricing. That's where your upside will come from. Price is not the same as value. Just because somebody puts the price of a stock at $20 doesn't mean it's worth $20. It could be worth much more at maybe $40, and that will be wonderful. We of course will be very interested to buy if that's the case. The reverse will also be true. The price of a stock could be $20 on the market, but the value is only $10. In such a situation, we obviously will not want to buy the stock because we will be on the losing end. So price is what the company is selling today on the market. It changes daily, but value is what the business is worth. These are two different concepts. Most people only look at what the price is trading today because it's easy. You just have to open up your brokerage account for a quote. They have absolutely no idea what the value of the business is. For value investors, we must first understand the value of the business, then compare it with the stock price. Before buying the stock, we want to see a significant amount of discount. So the next question is, how do you figure out the value of a stock? There are a few methods. The value of a company is derived from two sources. One, the asset of the company. This includes how much money the company has in the bank, what customers owe to the company, what properties the company has. 2. The future earnings of a company. How much will the company earn moving forward into the future in year 1, year 2, and so on. Asset-based valuation methods are much easier because it relies on compounding the company's asset, while earning-based valuation methods are much more difficult because it relies on us trying to guess how much the company will earn in the future. As you know, it's impossible to predict the future. For asset-based valuation method, a quick shorthand way is to look at the price to net asset ratio. This compares the stock price to the net asset of the company. The lower the number, the more discount you are getting. You don't have to calculate this yourself. You can easily grab this number off many places like Bloomberg, Yahoo Finance, or Morningstar. For me, I like to use Share Investor because it's focused on Singapore stocks as well. For earnings-based valuation methods, it's a lot trickier. Nobody knows the future earnings of a company. So typically, we will use the past earnings to estimate its future earnings. We take the price per share, divide by earnings per share, and this will estimate how many years it takes for this company to earn back what you are paying for it now. The lower the number is, the better. Again, you can grab this number off many websites. Another way to use earning-based valuation method is to conduct a discounted cash flow calculation where you project all its earnings into the future and discount them back to the present value. Discounted cash flow can be the most accurate and professional way to value a company. That is, if you can predict many of the different future variables. You need to know the company's future earnings, future interest rates, and future cost of capital. You probably won't have this information because nobody can predict the future. In my opinion, these are used by investment bankers to justify their high salaries. You don't have to worry too much about using this method. I personally don't use it because the output is only as good as its input, and we have no way to predict the future variables required for calculations. Valuation methods are a great way to quickly determine whether the company is overvalued or undervalued. But be warned that some companies are cheap for a reason. Perhaps the sky-high earnings are just a one-time off event. Perhaps the company is having cash flow problems. Or perhaps there are other hidden expenses or liabilities that have not been considered for. Be careful when using them. You need to combine them with many other factors to form a holistic view of the company. Once you identify a cheap company, you can then decide to buy. And once you are vested, here's a critical thing that you should do. Nothing. Yes, do nothing. It's my favorite part about this kind of investing because I'm a lazy person and I do not like to work for money. The key is patience. We are going to wait. This is like hunting animals. You don't just grab your rifle and go to the forest to shoot. You have to go in strategically, sit down, keep quiet and wait. You are waiting for an event that will affect the economy, the industry or the company so much that the stock price goes down well below the value of the company. The most recent event was in March 2020 when the pandemic affected the world. Companies went on sale. A year later, the general stock market recovered and prices are now even higher than it was before the pandemic. If you had bought in then, right after it bottomed, you would have made a lot of money on hindsight. As of right now, the S&P 500 is all-time high. The Shiller P ratio, which is based on the P ratio of average inflation adjusted earnings from the previous 10 years, is very high at 38.25. It's the highest it has been since the tech bubble in 2000. Due to this optimism, prices are very high and it's difficult to find companies with good margin of safety. Do you agree or disagree with this video? Subscribe, leave a like and comment down below, and I'll see you in the next video.